2 days of losses on the S&P. Will we make it three? From New York City this morning. Good morning, good morning. Equity futures down about 0.1%. We're all waiting for Chairman Powell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, Chair Powell taking center stage in Washington just before President Biden addresses the nation as this year's epic market rally flies into some turbulence. We begin with the big issue. It's Chair Powell, Volume 2.
You're going to hear Powell at the Economic Club.
Chair Powell.
You've had a subtle change since the Fed meeting.
The kind of strong payrolls report you got, but also the non-manufacturing ISM.
He basically said, all right, you guys want to play data dependent? We'll play data dependent. And guess what? The data was really hot.
I don't think he's necessarily going to take back some of his comments.
He doesn't have to walk much back.
I don't think that the data we saw Friday really changes much for the Fed when they look at the March meeting.
You have a different message right now.
Interest rates have definitely changed. They have gone up.
Real interest rates based on forward-looking break-evens are about 2% or higher.
They're going up because growth is proving to be stronger than expected.
Now he can let the data guide them.
That's a different flavor of rate increase. It's
Joining us now to discuss is PGIM's Lindsay Rosner and Colin Martin at Charles Schwab. Lindsay, first to you. After that monster payrolls report on Friday, what does it change for this chairman?
Yeah, I think what it shows us is that the economy is really hot. And that was what I think we were told by Powell. I'm not sure markets wanted to listen. So I think Powell's message was loud and clear, not free to move about the cabin right now, buckle up. And that number definitely was a bit of turbulence. So going forward, I think the Fed and Powell very much feel emboldened to get to their dots and stay there and not cut.
Citi on board as well. Andrew Hollenhorst had this to say this morning, 517,000 new jobs. He's calling it a clear sign of an overheated economy. Powell should sound more hawkish today. Colin Martin, do you agree?
Well, I don't think one jobs report is necessarily going to change the tone, but I do think Powell can be a little bit more hawkish in today's comments. What we heard last week was a little bit different than what we think the markets heard, because when you look at the statement made it very clear that multiple rate increases were likely. And Powell kept talking about disinflation, and it seems like the market picked up on just the term disinflation itself, but what we heard was that process had just started. So I think we're going to hear about where he views that process, but also financial conditions. That's still the mystery out there, especially his comments about financial conditions not really moving much recently, when what we're seeing from the indices we track is that they're still accommodative and they've eased significantly since last December. So I think that'll be a key question and something that the markets are going to be focusing on.
Well, this market has adjusted post-payrolls to a higher terminal rate in line with the Federal Reserve. Lindsay, where the spread still exists and persists is between the Federal Reserve and the market over rate cuts. Do you see that as confusion over the Fed's reaction function, or just a disagreement, a different view on how this economy is going to develop in the next coming months and quarters?
Yeah, so I think it's a slightly different view, but the really big thing is there has been a huge change. Basically, all the cuts that were in the back half of 2023 have been taken away. The market is not expecting that anymore, and you have to squint now to see the difference between what the Fed thinks will happen and what the market is saying. And I think that that's actually a really good thing for markets writ large, because you're not going to have that volatility of the chasm that existed between those two entities prior to this past week.
Getting a ton of Fed speak this week, not just Chairman Powell. We heard from Raphael Bostic of the Atlanta Fed in the last 24 hours here at Bloomberg. He had this to say: I've said for a long time that I thought there's a lot of momentum in the economy and that there was a good chance that the momentum was going to be sufficient to absorb our policy tightening in ways that could help us avoid a recession. He's in camp soft landing. He's looking for higher interest rates potentially as well. Mike McKee's got to break this down for us. Mike McKee, the latest from Chairman Powell, does it change after that payrolls report?
It doesn't change. It's a question of whether the market changes. I mean, our story so far, you just kind of went through it, was last Wednesday, Powell talked about the fact that the Fed is going to raise interest rates and keep interest rates at a high level, but there is some disinflation out there. The markets only heard the disinflation part. And then Friday, we get the extraordinarily strong jobs report, and markets begin to think Powell meant it. So the question today is not what Powell's going to say, but what's going to be the takeaway in the markets. Does he strengthen his message? Do the markets really buy into this? As of this morning, they do. You look at where the markets are pricing the terminal rate for the Fed, and you can see what happened here where we have Wednesday outlined and then Friday outlined. Since then, markets have really moved up. They're above 5.1% this morning, which is what the Fed's dot plot consensus had said would be the terminal rate. So markets are looking for Powell to be more hawkish today. I'll finish up with what Raphael Bostic said, because it is important if this is the way the Fed is leaning, and that is that the economy would now expect them to translate into raising interest rates more than they had projected. If everybody starts moving up their forecasts, we'll get new ones at the March meeting, then there's going to be a lot of adjusting to be done on Wall Street.
Looking forward to those forecasts a little bit later. Mike McKee down in Washington. Mike, thank you. Colin Martin, let's build on that. The prospect of a higher terminal rate. Reason to believe that might be the direction of travel.
It's certainly possible based on all the economic data we're seeing right now. I mean, the market is pretty favorable right now. If you look at the labor market, if we take away all the headlines that we see in the tech sector, and I think we need to step back and really evaluate what that's telling us, they don't make up a large portion of the overall workforce. They make a lot of headlines. They come from a lot of the high-flying stock entities. But at the end of the day, they're not the ones that really drive the labor market. And if we look at the JOLTS numbers, which surprised to the upside, the labor market, obviously, with the non-farm payroll surprising to the upsides, and then initial jobless claims continuing to decline, that shows us that the labor market is still strong and that the economy can potentially keep chugging along. Those are all good things. And what that means for the Fed and what that ultimate peak rate is, that they might be able to keep hiking rates. If the Fed can get to inflation around 2% and the unemployment rate only rises a little bit, I mean, the way I view that is that could be somewhat neutral at the time. Obviously, there's a lot of questions about what the neutral rate is over the long term. But if that balances the economy, that's ultimately a good thing, and why we're not expecting rate cuts anytime soon. So the Fed's only going to cut rates if they need to.
Let's talk about what it means for the market then, Colin, off the back of that good news. Is it good news for financial markets? The S&P 500 year-to-date is up about 7%. I think the Nasdaq's still up about 13.9% year-to-date, even with the 2 days of losses. You know the story with the US dollar. I think it's down about 10% from the peak at the back end of September. Credit, you were looking for wider spreads, Colin. Credit spreads since the wides of last year are 200 basis points tighter. And if you go to the junkest of junk, triple Cs, they've been running in too. Can you make sense of that for us? Isn't that just in line with a better economy?
It really is, and you're right. We were expecting wider spreads this year, and I think over the long run we still expect that to happen. But I think we want to break it out into what environment is this? Is it a recessionary environment or a non-recessionary environment? And credit spreads are telling us that it really isn't. That if that timeline gets pushed back, then spreads maybe at the 4% area for the high yield market is appropriate. We still think over time that we'll see those spreads rise, and how we're approaching the market, we still favor IG right now. If you can get average yields around 5%, we'd rather do that without taking much risk. Because if you look at high yield bonds over the long run, say 2 years, 3 years, an 8%-ish yield looks pretty attractive. But because spreads have come down so much, that break-even spread, how much spreads need to rise or could rise before that excess return is wiped out relative to treasuries, that keeps coming down. And all it would really take would be, a small little bout of volatility to see spreads rise back up to that 5% or so area. So we're still a bit cautious right now, but the markets, based on what we're seeing with new issuance, what we're seeing with the triple C market, as you just alluded to, is telling us that credit markets aren't too concerned right now.
I mentioned the low quality bias. Triple C spreads have tightened about 300 basis points from the wides of October. Lindsay, can you make sense of that for all of us?
Yeah, I think it's just the pricing in of a soft landing. We've gotten a lot better economic data that is decreasing the amount of recession risk. When I spoke to you last, Jonathan, we happened to talk about our base case being a garden variety recession. And given the new data, we've had to say, you know what, soft landing is edging out a little bit more. And you're seeing that come through in just those big high yield spread numbers you're discussing. But I think what's really interesting about the high yield market and what we're excited about is that there's dispersion. And dispersion is a great place to be if you're an active manager doing that security selection. And the dispersion in the high yield market actually is getting pretty close to the levels it was in 2019. that is a great opportunity. And that dispersion, I think, is a bit of a canary in the coal mine to tell you that there will be winners and there will be losers. And that's the kind of environment that we envision having for the rest of the year. It's been great that there's been a rally, but you have to be careful.
Can you just build on that a little bit, Lindsay? Where is that dispersion within industry groups? Where do you see that most pronounced within certain sectors?
Yeah, so when we're looking at dispersion, we're looking at name specific and where spreads are even within intra-sector. So it really is across the board that we can find opportunity. I think, to your point, triple Cs have done really well this year. They've tightened, and you kind of see this bigger theme of a compression trade. But we'd be wary of that, and that it's really picking out those values that we find and relying on our credit analysts to do so.
Some people, Lindsay, might say this is far too complicated for me. I can get 445 on a 2-year. Why wouldn't I do that?
Yeah, I think the big thing, and we've had a lot of conversations with clients who are discussing just that. I mean, certainly you have a yield in the front end of the curve that you didn't have a year ago, 2 years ago. We had been in that zero or even negative rate world. Well, the problem is reinvestment risk. So it's great that you can collect that for 2 years, but in 2 years' time, what are you actually going to do? And the other part of it that I think Colin was touching on is real rates. What are you actually earning from a real rate perspective? And so maybe it's a good portion of your portfolio. We don't believe it should be the whole thing.
Colin, final word.
Well, I'll touch on the point you made before about the pushback from a lot of investors about the short end versus the long end. It's the number one question we get, and admittedly, it's something that Tom Keene brings up with me and Kathy Jones all the time when we're on here. Why would we even consider intermediate or long-term bonds? And I'll just, follow up on Lindsay's point about that reinvestment risk. Yes, you're accepting a lower yield with a 5-year, a 10-year, you name it. But at some point, as the Fed rate hikes take hold and that slows down the economy and brings down inflation, that at some point will bring rate cuts. And once that happens, for those waiting to invest, waiting for that peak Fed funds rate, they might have already missed the peak in intermediate or long-term bond yields. So we'd rather not wait, just lock those yields in with certainty. But overall, as part of an overall diversified portfolio, to take away the timing aspect.
Colin, did I ask a Tom Keene question? In which case, I apologise. I'm sorry. Colin Martin, Lindsay Rosener, sticking with us. Coming up on the programme, President Biden preparing to address the nation.
We have a strong and resilient economy. I know President Biden will talk about that.
That conversation up next.
We have a strong and resilient economy.
The striking labor market report that we got on Friday obviously punctuated a historically strong period in the labor market recovery.
Last month, we created over 500,000 jobs, more than 12 million since the president took office.
We're seeing inflation moderate.
What I see is a path in which inflation is declining significantly and the economy is remaining strong.
Fresh tensions with China and a showdown on Capitol Hill looming over President Biden's State of the Union address. Speaker McCarthy calling the president to the negotiating table ahead of his big night.
Mr. President, it's time to get to work. The problem only gets solved when both parties come to the table. No drawing lines in the sand, no policy gimmicks or political games. We can have reckless spending or we can have responsibility.
This coming as the president looks to renew his proposal for a billionaire tax. A White House preview of the speech reading, quote, "This minimum tax would make sure that the wealthiest Americans no longer pay a tax rate lower than teachers and firefighters." For more down in Washington, here's Bloomberg's Anne-Marie. Anne-Marie, let's start with what's possible in this address later.
Well, not much when it comes to a billionaire's tax, Jonathan, or as well as quadrupling the excise tax on share buybacks. Remember, in the IRA, they were able to get a 1%, but many Democrats say that is just not high enough on these corporations. The issue is the president is facing a divided Congress. So a lot of this legislation he may want to pitch just has no legs in Congress right now. But the economy will be front and center. That is what Brian Deese told us yesterday in this speech. The president was given a gift on Friday. As he walks into this speech, he can claim that under him being president, it is the lowest unemployment rate since 1969. He was 26, 27 years old, John, when we saw an unemployment rate this this low. He is now 80 years old. The issue the president has is his polling numbers. The American people don't feel the economy that he is talking about, and that is a difficult position for him as he faces, one, a divided Congress, and also as he plans to announce a 2024 bid.
Just on the debt ceiling debate, there's a passage in this fact sheet the White House put out yesterday. It reads as follows. President Biden's predecessor passed the nearly $2 trillion unpaid for tax cut with benefits skewed to the wealthy and large corporations. And the deficit, and I think this is the key line, Anne-Marie, the deficit went up every single year under his watch. Do you expect that to be mentioned a few times later?
Absolutely. The debt ceiling is going to be looming large, and also they want to make sure that they are precisely pointing out the timeline of the debt ceiling. Republicans would like to say this has to do with Democratic spending. They don't want to talk about these tax cuts under the Trump administration, which we should note, Jonathan, many of those tax cuts still remain in place, even though last year there was a Democratic House, a Democratic Senate, and obviously a president from the Democratic Party. One key issue, though, is Speaker McCarthy yesterday, and you played some of that sound. He was speaking on the Capitol. He said there should be no lines drawn. But an hour later, a reporter asked him, when you want to decrease the deficit, would you consider tax hikes? He said, no, we will not. So in a sense, a line was already drawn by the Republicans. So this is going to be a showdown early this summer.
There is a spot where Republicans and Democrats might agree. China might be one issue. Here's another.
Yes.
And it might be connected to that China issue as well, that the Europeans have got a voice on this too. The administration is issuing proposed guidance to, quote, ensure construction materials from copper and aluminum to fiber optic cable, lumber and drywall are made in America. Anne-Marie, can something be done there? And what will the Europeans say about it?
So two things on this. One, it'll be hard to hear Republicans say they don't agree with that. Already the administration is trying to do this with the Inflation Reduction Act. If you want to get some of those subsidies and tax credits, they want these products built in America, but also critically the raw materials coming from America. This is where the Europeans think they could potentially make a play into getting involved in the IRA. And I spoke to Robert Habeck yesterday, the Vice Chancellor of Germany. He's the economy minister. And this would be a club, Jonathan, of sorts, a raw materials club. What's interesting, though, is that if you try to do this, it could potentially be a big hurdle for companies. Raw materials like aluminum, like copper, we saw this in the oil market. These are priced on a global commodity market, right? And some of the cheapest products are coming from China or coming from Russia. But potentially the president is going to be leaning into this a little bit more this week or last week. We talked about this yesterday. They're looking at a 200% tariff on aluminum for Russia, which basically means that any Russian aluminum will not be making its way to the U.S.
MH, thank you. And just for our audience in the UK, I know aluminium, but I'm just reading it verbatim off the fact sheet from the White House. Anyway, MH, thank you. Lindsay Rosener, Colin Martin, back with us. Colin, this nearshoring theme, deglobalization, all of the above, is that a theme for you as you look across this market?
Well, it's always a thing. One thing we look at, especially to the points you were just talking about, anything about uncertainty or the possibility of raising costs, that just plays into, one, the inflation theme, but also some sort of risk premium. If there's concerns about where we're going to source things, what the prices are, then we'd expect, maybe some volatility and some risks premiums to rise. So we're certainly looking at those. I think there's enough going on in the U.S. in terms of all the things we just discussed with the labor market, disinflation, Fed policy. But of course, things like that do play into our outlook, but they're probably taking a back seat right now.
Well, as you know, Colin, about 95%, 99% of these things is about conveying values, not about establishing a path forward to change policy anytime soon. But Lindsay, on the debt ceiling debate, it's not going away. As much as we hate it, and as much as a lot of people are exhausted by it, it's going to have to be something we talk about. Lindsay, what are you telling clients?
Yeah, we are absolutely going to have to talk about it. My hope is we don't have to talk about it until the dead date of August, that we can close out this conversation earlier rather than later. But it's absolutely something on the mind of clients, and it's important. We've been on the door of this before, and it obviously roils markets. I think you already see it in where U.S. CDS is trading. First of all, the fact that it is trading again, it wasn't trading for weeks, and now is actually a moving contract, that is moving higher. And so the risk is being entered into the system.
Is it doing anything to erode appetite from international investors looking at the fixed income market in America? Is it doing anything at all?
No, we have not seen that yet. We've definitely seen overseas interests overnight, especially in the investment grade market. this kind of goes back to what we talked about last time I was on the show, which is just this is a great year for bonds, yields, spread. And as my colleague Mike Collins said on Friday, with all the hikes that have been put in and where we eventually get, let's say that's 500 basis points, in some ways, there is the potential for a Fed put maybe again. They have the ability to cut to help the economy. Those things I think right now are far more important and far more critical for overseas investors when they're thinking about our market.
Lindsay, you've just got to build on that. Are you saying that after a year of talking about a Fed call hanging over this market, the Fed puts back?
I think it can be brought into conversation. It's certainly, we're at a different point, right? We've got 450, 475 basis points of room now if they needed to cut. That is a totally different story than where we were a year ago. So that cushion, and I'm not saying exactly where that Fed put strike is, don't hold me to that, but that it should at least be something that we do discuss because we're in a much different situation and a better one, I would add.
I was getting ready to clip it to play it back to you next time you come on. Colin, final word on that.
Thank you.
Final word is the dangerous words from Lindsay to say Fed put on a Bloomberg The Open. I think she makes a good point about how much room they will have to cut, though. So we'll stop short of saying there's a Fed put. I think what we're going to see this time around, where if the recession, if it ever does come, if it's more shallow and not what we saw over the past two, maybe we don't get back down to zero. Right? Maybe they get down to the 2%, 3%, something like that. But they do have plenty of room, significantly much more room to cut if they need to for now. So I think that is a good thing in the grand scheme of things.
It's amazing. Unemployment's at 3.4%. We've just had a payrolls report, 517,000 jobs, and we're still talking about the prospect of rate cuts. Colin Martin, Lindsay Rosner, to the two of you, brilliant as always. Equity futures right now down 0.25%. No real drama here. Up next, the morning calls, and later, why the latest read on inflation could unravel this year's rally. Citi's Stuart Kaiser around the opening bell. Equities a little bit softer. Let's get you some morning calls. First up, Credit Suisse upgrading Lockheed Martin to outperform from underperform, raising the stock by 2 notches on the company's improving growth outlook. Goldman downgrading Tyson Foods to neutral, saying cyclical headwinds should continue weighing on the company's profitability. And finally, Wedbush cutting its price target on Bed Bath & Beyond to 0, seeing a low probability that the retailer avoids filing for Chapter 11. That stock down 45%. Coming up more on Bed Bath & Beyond's latest efforts to elude bankruptcy, plus short-dated options adding fresh fuel to the meme stock trading frenzy. That all coming up next with Stuart Kaiser of Citi. Two days of losses on the S&P 500. Can we make it 3? Equity futures right now down about 0.25% on the S&P. On the Nasdaq down about 0.1%. Last couple of days, over the last 2 days, we're down by about 1.6% on the S&P. On the Nasdaq down by about 2.6%. Still up on the year. Big time. There's your opening bounce. Switch to the board and get to the bond market. Yields look a little something like this, turning higher by a basis point, about 3 hours away from hearing from Chairman Powell. Your 10-year 365, your 2-year nicely through 440 in the last 24 hours. Right now 445. It means some more dollar strength and euro weakness. Euro dollar last week, high of the week, high of the year, 110.33. Now back down to 106.92. We're down 1/3% on that currency pair. Looking at crude, we're positive 1 full percentage point, just short of 75 at $74.90. About 30 seconds into the session, no real drama here. Down 0.2% on the S&P, and the Nasdaq virtually unchanged. One stock to watch at the open, Royal Caribbean, reporting a smaller than expected loss with pent-up demand helping to offset rising fuel prices and a strengthening dollar. The CEO said this: travel strength continues as consumers shift their spending towards experiences, with cruising remaining an attractive value proposition. Apparently, Abby. Hey, Abby.
I'm with you on this, John. I was not a cruiser ahead of the pandemic, and I'm certainly not now. But apparently a lot of people out there are, and there's new cruisers, too, because bookings, that's the key to this story. Very, very strong, taking the stock higher. Its best day in almost a month, and it also suggesting that they are going to have record EBITDA for 2023. So there's lots of optimism about 2023. That quarter that just was, it was a little messy. Yes, they did put in a narrower loss than expected, but it was still a big loss. Sales were a little bit of of a miss. But looking ahead, they are again looking at that record-breaking wave season that you were talking about for the quote-unquote cruisers. Translation, that means that the bookings between January and March are very strong. And it comes off of a quarter that, even though the quarter was a little messy, more bookings than 2019. Imagine that. What's interesting here, though, John, the stock is still 48% below its pandemic high. For 2023, we are again looking at record EBITDA. We're looking at sales that were higher than 2019. So I'm betting that there are a lot of investors out there in Royal Caribbean that are hoping the stock follows those bookings, EBITDA, and revenue.
It's not a comment on the stock. I just don't ever want to go on a cruise. I always see the commercials for cruises, and they always say at the end you can make new friends. And I'm like, I don't want to make new friends, and I certainly don't want to meet strangers in the bar every single night. I mean, that just does not appeal to me. You want to go on vacation and get away from people, not bump into the same people and get trapped on a boat. That's over. Abby, thank you. Another stock to watch, Pinterest. The company reporting sales that missed estimates amid an advertising slump. The CEO said this: "We are very much focused on making sure that we return to user growth, but we are more concerned about driving deeper engagement." Kelly Lyons wants to talk about that, and I know she's got a rant of her own on cruises.
I just really want to tell you can't knock it till you try it, John. I am totally a cruise person. It's not about having to interact with people. It's about getting on the boat, and you don't have to do anything else. It'll take you to all those different places. Anyway, Pinterest, which admittedly I also was a user of, especially when I was planning a wedding, isn't doing so well when it comes to the top line numbers. The stock's down about 0.8% as a result. This really is an advertising story, John, because this is obviously a social platform that gets its revenue via advertisements. And we know that there is an advertising slowdown, which is why they just saw their lowest pace of revenue growth on record, 3.9%, really coming down from the highs we saw prior to the pandemic and then over the course of it when everything online was doing so well. But now it is a very different story. And to put it in the words of one analyst over at Baird this morning, this is a second-tier player. So if advertisers are pulling back, the dollars that they do spend are likely going to go to the bigger players like Alphabet or Google and Facebook. Those have about 70% market share compared to just 0.6% for Pinterest. So that paints a pretty tough picture for them there. If there is one bright side, though, that the sell side is pointing out today, is that engagement and user trends seem to be improving. Engagement like pins and comments is up about 10%, and they did just fractionally beat on monthly average users as well. So maybe that is why we are seeing not too deep losses in the stock this morning, though now they do seem to be deepening a bit, down about 2% before the bell. Also, go cruises, John.
Kaylee, I'll let you have the final word. Kelly Lyons, thank you. Also keeping an eye on Bed Bath & Beyond, shedding nearly half its market cap after announcing plans to raise $1 billion through an equity offering. Wedbush cutting the stock's price target to zero. Running in a note, we see these capital raising transactions as a last gasp to survive before filing for bankruptcy protection, where the common equity would likely be worthless. Bloomberg's John Edwards joins us now. John, fantastic to catch up with you. Run us through the state of play here and the chances of avoiding bankruptcy.
Yeah, it's an open question still. I mean, Bed Bath & Beyond, by its own admission, has been at the brink of bankruptcy for weeks now. And it did, late yesterday come up with this last-minute reprieve, offering some preferred shares and warrants to raise about $1 billion. So that should help it stave off a Chapter 11 filing in the immediate term. However, as you see, analysts are skeptical that this is going to be a long-term rescue for the company. It still has to fix its severe operational problems. It's having trouble keeping its shelves stocked. It's having trouble appealing to shoppers because they see that they're not able to find what they are looking for. So that remains an open question. And we'll have to see if this is really the rescue that they think it is.
Well, John, when you say the immediate term, I know this is so tough, so difficult to answer, but how much time have they bought?
Some analysts are saying, maybe a couple of quarters, maybe a little bit more, but it's again, they've really got to get that operational situation turned around quickly. I mean, they've had double-digit declines in same-store sales for several quarters now, and it's just, it's not a healthy situation for them.
That stock has been all over the place. John Edwards, John, thank you. The stock is down by about 39% in early trading, 6 minutes into the session. The broader equity market on the S&P down 0.25%, on the Nasdaq down 0.1. Citi Stuart Kaiser looking for next week's inflation report to give markets a dose of reality. He has this to say: markets continue to sidestep 23 landmines. markets, with events failing to produce negative enough outcomes and pressuring conservative positioning. We see risk tilted to the downside, with the onus now on CPI to disrupt the apple cart. Stuart, I'm pleased to say, joins us right now. Now, Stuart, before we get into it, there was a great piece in Barron's over the weekend about really short-dated call options. I want to share a quote with you and get your thoughts on it. It said, speculation has returned in another acronym, 0DTE, which stands for 0 days to expiration options. To help traders scratch that speculative itch, the exchanges have been offering ever shorter options until they got to 0 days to expiration. Now, Stuart, can you tell me about the kind of volume that we've seen in those very short-dated call options and what it may be doing to the broader market?
Yeah, Jonathan, it is kind of a new theme. I think it's a little bit distinct from the sort of retail options flows that we saw a couple years ago. But basically, in the S&P 500, you're trading about 45% of your total options volumes in options that expire by the end of the day. So call it about half of the options that are being traded expire, at the close of business on the day. So it's a huge thing. I would say the impact on the market is a little bit harder to discern. It's a lot of volume, it's a lot of churn going through the market. But contrary to other sort of fads we've seen in the last couple of years, which was very much people buying call options to have upside risk, this trading of zero-date options is actually much more balanced between puts and calls. And I think for that reason, you're kind of seeing it impact the market a little bit less on an intraday basis. Some people have speculated it's one of the things that's driven high intraday volatility because it's allowing people to add leverage to their kind of intraday risk-taking. And I think that's a possibility and still an open question. But regardless, it's a massive theme in options markets these days.
Well, what I'm trying to figure out is how much of the price action is just a technical story that we're trying to assign a narrative to, a fundamental narrative, Stuart. Just the year-to-date epic rally we've seen in some of these big names.
Yeah, look, I think the zero-date options, though, generally is not a single stock phenomenon. Most single stocks do not have daily options listings the same way the S&P 500 does. So while you may have people trading short-dated calls, let's say, on a Meta or a Google or pick your large-cap tech company, those are generally not going to be zero-day options because you just don't have 0 days listed for most single stocks. So this is kind of more of an index phenomenon than it is a single stock story.
Stuart,
any
difference this year to what you might have seen in years gone by? I remember discussing this in September 2020 and that mount up we saw in the NASDAQ. Any difference to what we're seeing now compared to back then?
Yeah, definitely. I would separate those into two slightly different categories. Back in 2020, this was largely retail investors buying call options in kind of 1 month in expiries on essentially large cap tech or popular names, right? And because that was flow that was one way into the call wing, it actually did impact the way that options were being priced. In our parlance, it inverted skew, i.e. your call was more expensive than your put, which is highly unusual. What we're seeing today, though, is not really single stock. It's much more S&P 500. And it's zero-date options, more balanced between puts and calls. So I think they're similar in that they're new developments. It's a lot of options volume being traded in the front of the term structure. But I would kind of separate out the retail flows going into tech call options from what we're seeing in zero-date options on the S&P 500.
So that's the difference between now and 2020. I want to talk about 2022 just briefly. You put out a note in November. And I remember this note, and I went back into it last night just to read through it. And you said this: will inflation crest before growth deteriorates, and let the FOMC deal with those risks to its mandate separately? For markets, how long an investable window is there between these two waves of economic risks? Now, Stu, I'm sure you remember writing that. Now, can you tell me where you stand on that now? How big is that window?
I vaguely remember it. Look, I think, obviously the window has proved to be longer than most people expected, right? I think a lot of people positioned that early in 2023, we were going to be more aggressively trading recession risks and growth risks. And clearly the data to this point has not provided that level of clarity on the downside, and the market's rallied. So from my perspective, I think the window is longer than we expected, and frankly, it's much longer than I think the bear case expected. I really do think people came into this year generally very conservatively positioned in the stocks they owned and owning less stocks than they historically have, in anticipation of kind of hard landing risks on the U.S. economy. And that hasn't played out. And really what it's allowed is allowed the market to rise. It's allowed the Fed to continue to message very hawkishly because they're not bumping into a severe deterioration in economic data, and particularly the labor markets.
With that all in mind then, Stu, how appealing is it to take on downside protection going into something like CPI next week, or to the risk events on the horizon in the not too distant future?
Yeah, it's a great question. I mean, from my perspective, being here above 4,100 is a very uncomfortable price level to be in, given the views on both economic growth and inflation. So I do think that CPI print is kind of a sneaky risk event, just because investors have largely assumed away inflation risk. So if you were to get a little bit of a surprising print there after what was a very, very strong labor market report, it's the kind of thing that could A, disrupt the rally, and B, I think embolden people to kind of lean against the rally we've seen, because a lot of macro and hedge fund investors in particular are very uncomfortable with the market at these levels. So if you have an excuse to sell it, from CPI, I think they'll take that opportunity. It is not as big a risk as it has been in recent months. I would say from a volatility perspective, it's priced at about 75%. The size of the event's about 75% of what it was last month. So big, but maybe not on par with recent history.
The ultimate risk event last year, as you know, was just pricing the Fed. And if you couldn't price the Fed, you certainly can't price the risk-free asset, treasuries, and you certainly can't price risk. That was because we went from a Fed calling for, say, 90 basis points of hikes last year to pushing through more than 400. There was just a feeling that we'd come into 2023, Stu, a little bit more comfortable, that we would understand that story more, that this Fed would ultimately get to, say, 5 and then stop. And then we'd have this conversation about cutting. After that payrolls report on Friday, do you think it reintroduces the risk we have this conversation about a Fed going to even higher levels than we thought about maybe in the last 12 months?
Yeah, look, I agree with you 100%. I mean, I think one of the big headwinds to risk-taking last year was bond volatility, which obviously came from volatile inflation data and an uncertain Fed, policy path. So this year, as we've transitioned, I think there is less bond volatility, obviously, in the markets, and I think there is less uncertainty about the path of the Fed, right? Even if you think, as our economists do, you're going to get multiple more 25 basis point hikes, that's not the same as going from 25 to 50 to 75, to talking about potentially 100, right? So the volatility coming from the Fed and from bond markets this year is, I think, undeniably lower than last year. Could it tick up a bit from how it's been early this year? 100%. That labor market report clearly made people uncomfortable. But I think there are some people also looking at that labor data and saying there was something a little odd here in some of these seasonal adjustments. And, if that number had been 300 instead of 500, the markets probably would have reacted a bit differently. So, big picture, yes, there is still some uncertainty from the Fed, but I believe bond volatility and Fed uncertainty is significantly lower than last year, which has certainly helped risk premium. Frankly, I think it is correlation between bonds and equities right now that's the bigger issue.
Final question, Stu, and this is an important one. Katie wants to know. Do you like cruises?
Well, you know me, John. I get on a cruise, I read about the Dow, and I just relax, So that's how I
get off the show.
No, I've actually never been. I've never been on a cruise. Never going to
go on a cruise. And never look at the Dow. Stuart Kaiser there. Silly, Stu, thank you. The Dow and cruises. What's worse than that? Coming up, tensions flaring between the US and China.
We made it clear to China what we're going to do. They understand our position. We're not going to back off.
That conversation still ahead.
We made it clear to China what we're going to do. They understand our position. We're not going to back off. We did the right thing. And there's not a question of weakening or strengthening. It's just reality.
US-China tensions looming over Washington as President Biden prepares to deliver his State of the Union address.
All senators and both parties will be briefed by the Department of Defense. The briefing involves where we stand with respect to China on everything from surveillance capabilities to research and development to advanced weapon systems and other critical platforms.
Emily Wilkins down in Washington joins us for more. Morning, Emily.
Good morning, John. Well, obviously this balloon has raised a lot of concerns in Congress on a bipartisan basis. You've heard that Republicans are interested in looking into some sort of resolution condemning China's government for the balloons and looking into as well as what the nature of these balloons are. We're now hearing reporting that there were a number of them during the Trump administration. That, of course, raises questions about what they're going to look like. And it will be interesting to see if Congress can actually muster a bipartisan support here. Initially, Republicans wanted some sort of resolution condemning the Biden administration for how they handled it. But there are also thoughts within both parties, really, that the focus here should be on Beijing and on China. Certainly we'll be keeping an ear open tonight to hear whether President Biden is going to be mentioning Beijing in any of his remarks. It is one of the few issues right now where Congress is unified. You see a lot of Republicans and Democrats be on the same page when it comes to China. And while we're expecting an all-hands-on-deck briefing for the Senate on Thursday, the House has requested similar. Also expect this to come up in hearings throughout the year. I spoke last year with Congressman Mike Gallagher. He's the head of the House's China Task Force, and he says that he does see this as being a part of further hearings on the U.S.'s relationship with China and what, if any, intelligence China was trying to gather through sending balloons over the U.S.
Emily, thank you. Thank you very much. A big question, I think, for all of us in this market now is what does it mean for you if you're invested in Chinese equities? The rally that we've seen over the last 6 months or so, 4 months, go back to the end of October. Baidu since then is up more than 100% since the end of October. It's up 11% today. A year or so ago, China was uninvestable. We said this yesterday. Now, seemingly for many people, it's unavoidable. After the events of the last week or so, Katie Lyons, what is it now? And for this stock, it's got its own story, hasn't it?
Yeah, it's been absolutely remarkable. Obviously, you have the wider picture, the reopening frenzy around China, but you have the artificial intelligence frenzy as well. And that really is what is specific to the Baidu story today. They have said that next month in March, they are going to launch their own chat GPT-like product, that AI bot that has caused such a stir over recent weeks, John. They are going to call it Ernie Bot for what it's worth. But really, this is just evidence of the competition and race to become dominant in AI. That is true for the U.S. and China, but private companies as well. We have seen just really remarkable moves in many different stocks related to the sector, like NVIDIA, for example. There is crazy funding going into companies that are investing in AI. We know Microsoft has unveiled billions of dollars into OpenAI, which is the operator of ChatGPT, and they're scheduled to have some kind of mystery event today, so we'll see what details, if any, we get about that. But just to underscore how much buzz there is about artificial intelligence at the moment, check out a chart my producer Dan Curtis made for me showing the news trend of articles about AI. It has absolutely boomed. You can see that there on the far end of this chart. So really it is about competition and trying to get in on what the market perceives, at least, as the next big thing, John.
Do you remember the end of 2017 where it was everything with Bitcoin and we saw those companies just renaming themselves?
Yep, just get it in the name to get around the hype. It feels very eerily similar.
Everyone piles in. Katie, thanks for that. Katie Lyons there. Abigail Doolittle has the sector price action for you. Hey, Abby.
Hey, John. Yeah, and it's a little interesting here. So we're looking at a small loss for the S&P 500, down about 0.2%. But we have some pretty wide moves. To the downside, it is all about defense, utilities, consumer staples, real estate. They are all down there. Consumer discretionary is also down there. So that's obviously one of the mega cap tech sectors. But the fact that you have consumer staples and utilities down, both of those being high dividend yielding sectors, suggests that on a day like today, when yields are basically flat, maybe investors are expecting yields to go higher. Up top, though, we do have some growth sectors of technology, materials. Energy is also up there. And you and Kayla were just talking about that China tech story. Well, there it is from sort of the October low, but pretty amazing, up 42%. I found another measure, John, up closer to 60%. So, yes, investors seem to be back in on that trade.
Abby, thank you. Two main risk events. I guess there's one, really, later, 12:30 Eastern Time. It's Chairman Powell, Volume 2. Any different to what we heard from last Wednesday after that blowout jobs report? 517,000 jobs. No idea where that came from. Unemployment at 3.4%, the lowest since the 1960s, and wages didn't pick up too much. I wonder what Powell thinks about that. Certainly, the President of the United States will be using that report in his address a little bit later. Up next, your trading diary from New York. This is Bloomberg. Twenty-five, 26 minutes into the session. Pretty marginal stuff here. No real drama, as we've said a few times this morning. Three-day losing streak on the S&P. We're down about 0.2% on the Nasdaq, up about 0.1%. That's the price action. Let's get you the trading diary. Coming up, Fed Chair Jay Powell speaks from Washington at 12:30 Eastern. Plus, President Biden delivers his State of the Union address later this evening. We get earnings from Uber and Disney on Wednesday. A host of Fed speak through the week. Williams, Cook, Barr, Bostic, Kashkari, Waller, all on the agenda. Thursday morning, jobless claims onto Friday. The UMich Sentiment Survey to close out the week. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.